Ask an American investor what they're worried about today, you'll hear the usual suspects: Fed rate cuts, conflicts, or the next tech bubble. But a major systemic risk to U.S. retirement accounts and portfolios is completely absent from that list. The true origin of the next financial crisis is sitting thousands of miles away, in Japan. By focusing almost exclusively on Washington and Wall Street, common investors are missing a multi-trillion-dollar threat brewing across the Pacific. We saw a preview of this destructive power on August 5, 2024. This is a chart of the Japanese Nikkei index. In a single trading session, it dropped 12%. To find a worse single-day crash in Japan, you have to go all the way back to 1987. The panic reached the U.S. immediately. The S&P 500 fell, and the VIX, the market's volatility index, spiked to levels rarely seen outside of a recession. The August crash signaled a violent failure in a massive hidden mechanism: the yen carry trade. This mechanism relies on a specific policy. For years, the Bank of Japan kept interest rates near zero. Global hedge funds realized they could borrow yen at no cost, creating nearly free capital. They would take that cheap currency, swap it for US dollars, and pump them into higher-yielding assets like US stocks, bonds, and crypto. Investors pocketed the returns from the American markets while paying virtually nothing back on the original Japanese loan. Trillions of dollars moved through this exact cycle over several years, creating a massive, invisible wave of liquidity. This means the recent American bull market was heavily subsidized by an ocean of cheap Japanese debt. This trade only works as long as the yen remains weak and Japanese interest rates stay at zero. But Japan is now being forced to normalize its economy and finally raise interest rates. To support their currency, Japan recently sold off dollars to buy yen. The exchange rate moved from 160 to 155 in just a few hours, a massive surge in the yen's value. That intervention invalidated the core assumptions supporting trillions of dollars in global investment positions. This creates a mathematical trap. A stronger yen makes those original debts much more expensive to repay, even if U.S. stock values haven't changed. To cover these ballooning loans, investors are forced to liquidate their U.S. holdings immediately and convert cash back into yen. This chain reaction is known as the unwind. When trillions of dollars are trapped in the same trade, everyone tries to exit at once. The result is a cycle of forced, rapid selling that ignores market fundamentals. A single policy shift in Tokyo can mechanically trigger a mass liquidation of American stocks. The Bank of Japan is now in a lose-lose scenario. If they keep the yen weak, domestic inflation becomes unmanageable. If they raise rates to save their economy, they risk a global market crash. Every single policy decision made in Tokyo now carries a direct, immediate risk of triggering a massive global financial contagion. Millions of American retirement portfolios are now directly and inescapably tethered to the impossible choice facing the Bank of Japan.